Today, we will look at the bear market and focus on how to invest when times are not so good. And we will begin right now. When green days are rolling, investing can be so much easier as almost any stock you pick is going to move up with the overall financial tide. In fact, that confidence you pick up during the good times can be a hindrance when the tide starts to recede. Investing while everything is falling is a different game, and unlike the rising days, random stock picking can get you in, well, quite a bit of trouble. You may have heard that smart investors make their money in these falling or bear markets, and it is true. There is a lot of opportunity to build up your portfolio on the cheap, and the returns on the other side can be pretty good. Before we go stock shopping, let me know in the comments if you have a strategy that you are using in the bear market. As always, I am very grateful to see you all here in the home of free financial content on YouTube. If you are new, please subscribe right now so you won't miss a single moment. And a huge thank you for that click. The place to begin is to talk a wee bit about what exactly a bear market is. A bear market is the market that is experiencing a prolonged price decline that can be the result of a troubled economy or can happen in response to major world events. Mathematically, a bear market is called when the average security prices have fallen 20%. Our current bear market was called on June 13th, 2022, when the S&P 500 fell through that 20% mark. That fall did, of course, begin all the way back in January, so it sure does feel like we've been in the bear market all year thus far. Interestingly enough, the average bear market tends to last for just shy of 10 months, so hopefully that means if we are average, we could see better days in the spring. Unfortunately, we must ask if this bear market is the average, and with an impending recession on the horizon, that may not be the case. This bear market could easily push well past the average as it feeds off of a recession, and in that case, things could be in the red for a lot longer than we want them to be. The question then becomes, is that really a bad thing? If smart investors make their money in a bear market, can a prolonged bear market be an even bigger opportunity for investors? A prolonged downturn in the economy does have a danger in that it can shake out some companies. If a company enters an economic recession without the fundamentals to weather that storm, they may not survive. That is a company in the bull market that could have made you money, but in a prolonged bear market, their debt catches up with them and the reduced cash flow eats away at them. Bankruptcy could be a result in some of the worst cases. As an investor, those are the companies we do not want to be holding in a bear market. There tends to be two very popular approaches to how to invest in a bear market. Some people will look towards moving their investments into a more dividend-heavy portfolio. Receiving dividends while everything is falling can definitely be a nice psychological boost in that sea of red we get very accustomed to. However, do we really need the maximum amount of dividends to get that boost? If you fall into a pure yield-chasing strategy, there is extra risk there, and you will want to be paying extra attention to the higher yield stocks. The other method is a blue chip safe approach that sees you investing in the tried and true companies with the fundamentals to weather a prolonged bear market. The good news with this approach is that it can be fantastic for growth investors and total return investors. You will not get the super high dividend yields, but you can still make a good amount of dividends with this strategy. If you were to look at a stock like Scotiabank, their dividend yield in January was 4.12%, which is a solid dividend for a blue chip growth stock. Today, in the bear market, Scotiabank's share price has dropped by about $25, and as a result, their current yield is 6.22%. This is a fantastic yield on a stock that will weather the recession, and on the other side, will more than likely look towards some growth back towards their old share price. Investors who bought at the 6.22% are still getting that yield on those shares even when the price returns. It is true that they will, of course, get the lower yield when the stock recovers on the new shares bought while the yield is lower. However, the great yield purchased during the bear market persists on those stocks. That was just one example. And there are many blue chip moderate dividend stocks doing the exact same thing. The bear market is an opportunity to buy these stocks for their overall stability and then stay for some of the jacked up yields. Blue chip investing is fantastic in a bear market, but What if you do invest in a fundamentally unsound company? That happens, and sometimes even good companies can falter, and their fundamentals can change in the wrong direction. Some investors get caught up in a never sell at a loss motto. You certainly do not want to haphazardly sell at a loss, as that is a great way to realize those losses. However, there is the concept of sideways trading. If I am in stock A that is down 20%, and I'm worried about their fundamentals, and then I see stock B also down 20%, but with very good fundamentals, it can make a lot of sense to sell A and buy B. Moving your money in this case is not technically a loss, even though it does generate one on paper. It is mathematically sound and in all likelihood will make you more money in the long term. If you do this in a non-registered account, you can claim that paper loss and save on some capital gain taxes on another stock that made you a little bit of profit. With some of these benefits of buying stable stocks at a discount, it can be tempting to pour as much money as possible into the market. But you want to also remain very cognizant of the world around you. You want to make sure you have the funds to meet your needs that have been also jacked up by inflation. You also want to have your emergency fund implemented in case the recession hits your job. The last thing you need as an investor is to have to pull stocks out at a loss because you overfunded your investments. Those are the losses you never want to incur. More often than not, that emergency fund can absolutely save your butt. You will want to make something, and I don't even know where I'm getting that from because it's not on the script. The fun does not have to end here because you can always watch my video on emergency funds that I have linked on the left, or you can check out the video on the right that YouTube thinks you will like. Your click will decide who is right, and I will see you in the next video.